To end, I wanted to just kind of share with you a new partnership that we have had in the past quarter. We have partnered with an organization called Pets to Vets, and Pets to Vets is an organization that provides animals to veterans who have either physical or mental disabilities based on their time at war. I also believe they work with first responders as well as veterans. We had our first adoption in December, and this guy right here, Jimmy, has his new dog, Marty. And what was particularly special about this dog is that the dog was living on the Staten Island ferry with his person. And his person loved him, but couldn't keep him, recognizing that she was homeless and was living on the Staten Island ferry. It wasn't appropriate for her to have the dog. So the dog came into the shelter right at the time where Jimmy was coming into the shelter looking for his new family. And it was really, really heartwarming to see that we were able to make this match through this particular program. It was very exciting. We've had communications with Jimmy since he's adopted Marty, and he says he's an amazing dog and perfect for him, and helping him be more social, and helping him to get out of his house more, and helping him to be a more productive member of the community. So we hope to have more programs like this where we can really match people and pets, because as we all know, the human-animal bond and the connection that animals give us is really powerful. There's also a connection that we give to animals. So if we can partner that together, and we can do more things like putting Jimmy and Marty together, it can really not only help the animals, but really make a difference, I think, in the community. So I'm going to leave it at that, and thank you very much.
Thank you. I have just one question. It's nice to see the euthanasia numbers go down. Obviously, it's still too high. Roughly what proportion of those are, cats versus dogs, and do you know how that's changed over the last few years?
I don't have the stats with me, but on anecdotal, I'm going to tell you that it's more cats than dogs. Again, the challenges in our buildings are large, bully breed type dogs and adult cats. So we really need to be focusing our energies on that population, or those populations, in an effort to not only highlight the benefits of adopting an older animal, but to also try to demystify the challenges that some people have when it comes to pit bulls or bully type dogs in the community. Because many or most of the animals that come in our care are wonderful dogs with the right home. So we definitely have seen, and our New Hope Partners is another example. We get more animals out through New Hope. We get more dogs out through New Hope than we do cats through New Hope. So there just seems to be a lag of cat adoptions that we really have to highlight.
I said one question. I have one second question. Do you think that we can make a substantial difference in terms of the number of new cats coming in? If we could reduce the number of intakes, then our adoptions could hopefully come closer to meeting up with our intakes.
Well, if we can provide resources to pet owners in the community, regardless of dog and cat, that help people find suitable matches before they get the animal, and then keep the animal in their home if they can. There's significant challenges in New York City with rental properties that don't allow pets or don't allow large animals. But that doesn't mean that's all stuff that we couldn't work towards. I mean, we can definitely communicate more to people. We can communicate more to landlords. We can give more resources to people in the community so that they keep their animal. We can highlight spay-neuter and the importance of spay-neuter to your pet, but also to overpopulation. So yes, there are a lot of things that we could be doing.
Thank you.
And we audited the fiscal year 2010. And if we turn to the first page, which would be our draft audit report issue, you'll see it's an unqualified audit report.
Are you talking about this one here?
That's it,
yeah.
yes.
Okay. Got it.
Okay. If we would turn to the second page, and it's the changes of assets and liabilities 2009 versus 2010. The overall assets of AC&C increased 10%, $159,000. Liabilities increased 24%, $227,000 in 2010 versus 2009. In regards to most significant increases in 2010, we saw unconditional promises rise $257,000, primarily due to receivables from one major contributor, grantor. Prepaid expenses was another increase of $96,000. That was due to the timing of the insurance schedule payments. Looking at the decreases on the assets, cash is down $124,000 in 2010 versus 2009, mostly due to the timing of payments to vendors, as well as the increase in accounts receivable. Property and equipment is down $64,000, and that is due to depreciation of our fixed assets. Dropping down to the liabilities with the increase of 24%, most significant increases in the liabilities over the prior year was the line of credit, rose from $0 to $300,000. Accounts payable due to the City of New York is $2,000, and that's the interest for the 2010 fiscal year. Deferred rent payable, $6,000, up, and that's due to the straight lining of the lease. And other liabilities up $16,000, primarily due to New York City licensing fees and sales tax. Increases in the liabilities. Accounts payable, the increases were offset by decreases, Accounts payable and accrued expenses are down $44,000, and that's due to the timing of the payment vendors from 2010 versus 2009. Salaries and payroll taxes payable are down $40,000, and that's just less days accrued from 2009 versus 2010. And lease payables down $13,000 or 85%, and that's due to the principal payments made in 2010 on the leases. If we drop down to the equity section, changes on unrestricted assets. Unrestricted assets are down $10,000, almost close to a break even. Unrestricted revenue support and gains are down 3%, $346,000, almost close to a break even. Unrestricted expenses are down 2.9%, $336,000 over the prior year. Dropping down to changes in restricted net assets. Temporary restricted net assets decreased $58,000 over the prior year. Although grants and restricted income over 2009 rose to $532,000, the increase primarily due to the timing of a major grantor, the effective date of the contract. This was offset by a significant increase in the releases from restrictions of approximately $553,000. Total grant income for 2010 was $826,000, and totally temporary restricted grants carried over from the prior year totaled $307,000. Total grants released from restrictions were $885,000, leaving a balance of $248,000 in grants not satisfied in 2010, which will carry over to 2011. If we turn to page 3, and looking at the changes in support and expenses, overall support decreased 4%, or $413,000. Expenses decreased 3%, $336,000 over the prior year. The major changes in the income on the statement of activities from 2010 versus 2009, contract revenue from the City of New York decreased over $1 million, primarily due to the decrease in the contract value. Shelter revenue is down 19%, or $204,000, primarily due to the transfer of the Big Fix program to another animal care provider. Contributions are up $757,000. However, this is predominantly due to the timing of the major branch's contract effective date. In-kind donations are up $159,000 in 2010, and that's predominantly due to donated billboards that occurred in 2010. Other miscellaneous income is down $85,000, and this is due to a drop, majority due to event revenue drops and retail sales. If we look at page 11, which I think is an easier way to look at the changes on expenses from a functional level, it should be the last page. Major decrease. Salaries and benefits are down 3% overall, or $216,000 over 2009. This is primarily due to staff reductions and decrease in overtime. From 2009 to 2010, AC&C experienced an overall 10% average drop in employee headcount. Advertising, postage, and printing is up $245,000, and that's primarily to the posting of the donated billboards that occurred in 2010. Human resources development significantly increased $72,000, and that's due to the recruiting costs had rose in 2010. Medical supplies and services are down 17%, or $82,000, due to the decrease in surgical supply purchases. Occupancy expense is up 17%, or $73,000, primarily due to the increase in utilities and the increase in rental costs. Professional fees are down 26%, or $162,000, predominantly due to the decrease in legal fees, public relation costs, and independent contractors. And the next major change from one year to the next was in supply costs, and that's down 38%, or $234,000 from 2010 versus 2009. Overall, AC&C came close to a break even for this year, a $10,000 difference on the unrestricted, a $58,000 decrease on the temporary restricted. So although revenues and support revenues decreased, expenses were almost equal to offset it. Any questions?
questions from the board? Okay. No, do we need to move to accept the audit report?
Yes.
Yeah.
So moved.
Okay, all in favor? Accept the audit report. Okay. All for acceptance. Financial review. Joe is going to give us financial review, and because of the time, I could ask you to just be as quick as possible.
Surely. Good morning. My name is Joe Balen, and I'm here to review the financial results for animal care and control for the first 5 months of the fiscal year, which is from July through November. For that period, total revenues for the organization came to roughly about $3.5 million, which is about 9% less than budget, or about $342,000 less than budget. 2/3 of that reduction really has to do with timing of expenses rather than just reductions in funding themselves. And that is because the DOH monies that are received are used to pay for certain expenses, and if those expenses don't happen in the first 5 months, which they didn't, and you'll see that when we're looking at the expenses, we don't recognize that revenue. So 2/3, or a little over $200,000 of the money that is less than budget really has to do with timing of expenses, and those expenses are anticipated to incur throughout the year. The other two areas are a little bit less in contribution revenue and lower shelter and adoption revenue. And as Julie has already mentioned, adoptions are down, so adoption revenue is also down. On the expense side, for the first 5 months, expenses are about $437,000 less than budget, and that's on page 2. And that is across just about all expense categories. Most of these are due to timing. So the areas that had the biggest savings to budget to date, medical supplies and services, professional fees, and supplies expense, are all really timing-related expenses, and those expenses are anticipated to incur between now and the end of the fiscal year. So we will be at a balanced budget by the end of the year. If we turn to page 3 and 4 and just take a look at the year-over-year comparison, first 5 months of the current fiscal year, fiscal 11, compared to the first 5 months of last year, the financial results show an improvement in the first 5 months, but the reality is that both on the revenue and on the expense side, revenues are significantly lower than last year. Expenses are significantly lower than last year. So when we talk about a year-over-year comparison, what we're really saying is that we're holding firm in terms of managing the funding that we're getting, and AC&C is doing a really good job of keeping the expenses matching up to the revenues. Turning to page 5 and 6 on the balance sheet. Total assets as of the end of November were $1.7 million, and that included a cash balance of roughly $800,000, which is about a $90,000 reduction from prior fiscal year. The reduction in cash is primarily due to payments made to the accounts payable to reduce our accounts payables that had built up at the end of the year, and also that's primarily the big reason. And also by the end of November, AC&C had paid down the line of credit that it had taken out, $300,000 loan that it had taken out in the prior year. An increase in accounts receivable reflects some additional grant funding that is being received by AC&C in fiscal 11, which is great news. Prepaid expenses were lower than year-end as healthcare payments were made in June of 2010 for the upcoming year, and as the year progresses, we reduce that each month so that it draws down. The reduction of property and equipment balance basically reflects depreciation expense. We really have not been adding any new capital items to the organization, so we're just depreciating the assets that are in place, and so you'll see that property and equipment amount continue to draw down. Total liabilities were $821,000, which is a $377,000 reduction to year-end, and that is primarily because the organization has been able to reduce the accounts payable that was due at the end of the year, meaning that they've been managing their money really well and paying the bills on time. As I've already mentioned, AC&C also paid back the $300,000 line of credit that was due, and so at the end of the year, at the end of the fiscal period right now, at the end of November, the organization is in good financial shape, not great financial shape, but it is in this situation where it's able to meet its obligations, meet its bills and things like that, and still continue to move forward. And a lot of that really is due to the fact that there's a lot of careful monitoring of expenses and control, making sure that no monies are spent without funding being in place. Thank you.
Okay. Thank you very much.